We start the talk for today. My view is that we shouldn't buy a stock for any other reason than the fact that you think it's selling for less than what it's worth, considering all the factors about the business. So you have to buy a stock cheap in order to make money. This is the basic philosophy given by Mr. Warren Buffett, and I think nothing beats this one as compared to any other way to buy stocks. As per me, what the market setup is, US money markets have done a U-turn and now expect another rate hike at the July meeting of the Fed. So if you see, the bond yields are again going up. The 2-year bond yield has gone above 4, and even the 10-year yield has spiked up. The dollar has become more expensive, crossed 104. So they are again pricing in another rate hike because of higher inflation and uh, the strong growth. Now, how is it strong growth? Because the manufacturing PMI for May is all below 50 for all the developed countries: US, UK, Germany, Japan, the Europe area. But the services PMI is showing robust expansion. It is above 50. So any PMI which is below 50 is showing recession, and PMI above 50 always shows growth for future. So now in this environment, in case the overall PMI is above 50, so the growth prospects are good. Now in that environment, how do the central banks cut rates? Now another thing which has played out in the US market is the AI-led euphoria, and the complete Nasdaq is up because of that. The biggest gainer of this is Nvidia, which makes these AI processors. It posted a 24% rise in share price on Thursday only of the last week. And just for your information, Nvidia is not a small company, but with a market cap of approximately 1 trillion. So now it is trading at more than 35 times sales. What I want to highlight is moment there is an euphoria on any stock, the valuation is not a concern, as we have seen during the times of euphoria, where there are bubbles in the stock market. Stock prices go to any level. Now coming to India, the private sector capex is looking up, both for JSW Steel and EIH. EIH is the company which runs the Trident and Oberoi hotels. IRB Infra's Q4 results have shown active tendering activity. They're gaining a lot of fresh orders, good EPC execution, and the toll collection has improved. Hence, they are showing good profits. BEL, Bharat Electronics, has had robust order inflow and improved execution, which is again reflected now in their profit and loss account of quarter 4 and stock performance. Ashok Leyland came up with a strong results. It has a strong product portfolio, and it has increased its market share, which will which is basically due to the company's business, which is to support the construction, mining, and infrastructure sector. Strong economic revival is supporting Cummins India, which is again reflected in their stock price and their Q4 results. The stock which I was referring to regarding the AI aspects in India was RateGain Travel Technologies. It's a travel focused SaaS player. It is the one of the world's largest processors of hotel booking, pricing intelligence, and customer travel intent. It provides SaaS solutions for travel and hospitality, helping them accelerate revenue generation through acquisition, retention, and wallet share expansion. Recent acquisition of a company called Adara has provided them AI-powered travel intent data. which is now going to be, once it is fully integrated into the company, it will help improve their margins, revenues, and profits. With the travel and tourism sector embracing technology in a big way to maximize revenue and optimize costs, order inflows and the pipeline remain strong. The earning trajectory in future is exciting. It is expected that it is likely to grow at 42% CAGR between FY23, that was last year, and expected earning for FY25. So, if you see the forward P for earnings of FY25, it is 32, and it has come down much from the listing time when it was priced at more than 100 times earning, and the stock price is still below the its IPO price. So it is one of the stocks to see and keep under horizon.
Which I wanted to cover today was about how to judge the value of a stock based on price to book. Last time we had seen the price to earning, and so now this time we'll see price to book value and what is the correlation of this with ROE, return on equity. So as we know, the book value is the value that shareholders would receive in the event of liquidation of a company. So it is the company value as reflected in the financial book of accounts, or this is the value which the accountants give to a company. So a company's book value can be determined by subtracting the cost of its liabilities from the value of its assets. And as we had seen the initial part, initial lecture on, we had seen on balance sheets, thus if you subtract liabilities from assets, it is basically the owner's equity. So that is the value the company would get in the market upon liquidation if it were to sell all of its assets and settle its liabilities. So book value per share is total assets minus total liabilities divided by total number of stock. That is book value per share. Now, why the book value is considered for financial stocks is because their performance is dependent on how they are using their assets. What sets one bank apart from another is how efficiently it utilizes its funds and manages its spreads and credit quality. Spreads is the difference between the cost of funds and the price at which they lend, or the rate at which they lend, and the quality of credit, that is how much of their assets, that is loans, turns into NPS subsequently. So the price to book value allows banks to be classified based on efficiency of use of funds in different price to book value brackets. We have all seen that certain banks like HDFC Bank, ICICI Bank trade at much higher price to book value bracket as compared to the PSU banks, and some banks which trade at below even their book value, that is below 1. I'll show you all this subsequently. But the other reason why we need to see the price to book value is that if a company is in loss, like earlier we had a lot of PSU banks which were in loss, the price to earning ratio doesn't give any meaningful insight about the stock. So in such a scenario, the book value is a effective way to understand the efficiency of the company. I would request all of you to please keep your volumes off. Okay. Now, what is the correlation between price to book value and ROE? If you visualize the balance sheet of a company, the book value of a company is the sum of its equity and free reserves. So basically, I'll again say the same thing: assets minus liability is equity and free reserves only. Now, price to book value can be a lot more effective when combined with ROE to understand how the performance of a company is, because ROE captures the aspect of return on assets, that is also the return on capital employed. Now, if you see the ROE formula, it is net income upon shareholders' equity. So, the shareholders' equity is the common aspect which is there in book value also, and return on equity. So, what return on equity captures is the profitability of utilization of shareholders' equity. That is the reason the price to book value and ROE are related. So, price to book value and ROE should move in tandem. Now, the key issue is the growth matters because if a company earns more than the cost of equity, the ROE will be higher. That is, in case uh, if you deduct the income which they are going to get from lending from the cost at which they are borrowing is the profits which the company gets. So what we have to find is the companies which have got low price to book ratio with high ROE. These are the companies which are undervalued. And if you find any companies which have high price to book ratio but a low ROE, that indicates that the companies are overvalued. Now let's see this. What I did is I have tried to predict the price to book for a stock. So what I did is I took 14 banks consisting of seven private banks and seven PSU banks. Please switch off your volume, please.
volume.
Okay. Now what I did is these are the 14 banks which I took. I took their present ROEs and present price to book, and it's a mix. So it is basically seven private banks and seven PSU banks. Now I did basic simple regression analysis and tried to plot them on ROE on x-axis and price to book on y-axis. So with regression, I got a equation in this basic regression equation of y is equal to a plus bx, and I found a equation related to this. And here, if you see, this is the baseline or the median line of this relationship between ROE and price to book. So what I am doing here is with ROE, I am trying to predict what should be the price to book. That is, how much should be the market value of a stock, of a financial stock. So if you see, there are seven stocks which are above the median line, which basically indicates that they are expensive, and seven stocks which are below the median line, which indicates that they are relatively underpriced. But here, one more thing which has to be seen is anywhere where the return on equity is below the cost of capital, there is no point in getting interested with those stocks like PNB here or IOB here or IDBI Bank here. And this is the reason why they are also quoting at lower price to book. If the ROE is less, you will see automatically the price to book, that is the value which the market is giving them, is also less. So what we have to see is which are these funds. The ones which are above the median line, I have plotted I have given them a background of yellow. So the balance ones are the ones where I see that there is a scope for increase in their market price, where the price to books can go up. Now, if you see here, you will see there is a clear differentiation between the price to book which the market is giving to the PSU banks vis-a-vis the private banks. That is also because of two factors. One is the growth, and second is the risk to earnings. So, if there are higher risk to earning, the market automatically gives a lower multiple to the stock. So, we will see this further. So what I did was I made a linear regression equation on this format: y is equal to a plus bx. Y is the dependent variable, that is what was on the y-axis, that is the price to book. X is the independent variable. I plotted on the x-axis, that is ROE. B is the slope of the line, and A is the y-intercept. So my equation, which came specifically for this data only, it can't be used for any other, but for this data of 14 banks, that is the price to book is equal to minus 0.63 plus 0.196 into ROE. Now, based on this equation, I found the predicted price to book of these stocks. And as I brought out, you will see that the ones which I have highlighted in red are the ones which are trading below the predicted price to book. And the other ones are which are there in yellow are relatively fully priced or overpriced or expensive. So here it is clearly, and you can do the same thing with other sectors also, where we can plot the price to book and ROE of those ones, and then see the relationship and see which are the ones which are underpriced or which are overpriced. So this is a simple way to use a linear regression equation to arrive at as to how to select stocks and which are really attractive. But you have to consider the growth and the risk to earning while considering this, because obviously if the market is giving lower price to book like in Axis Bank, as where the ROE is higher as compared to HDFC Bank or ICICI Bank, it is basically because market is expecting higher risk to earning and lower, it is giving a lower growth premium. But in case it could be highly possible that it is right now underpriced. Similarly with ICICI, SBI also. Here in this case, I find that AU Small Finance Bank is very expensive. So banks like SBI, Bank of Baroda, Canara Bank, they are relatively underpriced, and the market is also giving them lower price to book. Okay. Now I'll go to the next aspect, which is the basics of selling options and what I gathered, my understanding of uh, the the way the Suri sir is dealing with the his options. So I'll just take one example and explain to it quickly. I'll cover the basics so that everybody is on the same grid. So basically, there are two parties to an option contract: a buyer and a seller. A seller is also called writer. He sells the option to buyer in exchange for a cost, that is the premium. So the buyer gives a premium to the seller, so that is kind of an assurance that he will buy uh, the underlying at a later date. So basically, he is essentially selling the right to buy or sell the underlying security at a predetermined price, which is the strike price. Now, remember this word about strike price, it is the predetermined price. A call option gives the holder the right to buy, and a put option gives the holder the right to sell the underlying. Again, I want to say it is a right only and it's not the obligation. The call option, where spot price is higher than the strike price, it is said to be in the money, implies that the example which we are going to consider, if the strike price is 1400 for Infosys and the current market price is 1317, that means the spot price is lower than the strike price, hence it is not in the money but it is out of the money. But in case the spot price of Infosys goes above 1400, then it will become in the money. So a option holder always makes money in the money options only, whether it is buying puts or buying calls. So if the spot price is lower than the strike price, the call option would be out of the money. Now, what is the risk? Because it seems very easy when the money making is very easy, we all find that we get carried away. Now, let me explain the risk to it so that people understand what is the risk in option selling. Firstly, when you buy an option, the risk is only loss of your premium. But when you sell an option, I'll give an example of the same option of Infosys 1400 CE. Infosys can theoretically, the stock price can go to infinity. So in that case, a option buyer would exercise his right to buy at the predetermined price, strike price of 1400 only, because he has gone into a contract saying that I will buy it at 1400 and sell at infinity. So he will pocket the infinite difference. So he will make supernormal profit. But now, as an option seller, if I am obligated to sell Infosys to a buyer at 1400 and I don't actually hold Infosys, to make good my promise, I have to buy Infosys from the market at infinity and sell it to the buyer at a meager price of 1400. In other words, theoretically, the option seller can incur infinite loss. So this is the risk part of option selling has to be understood. Now, how do we limit this loss? I think somebody's audio is on. Please switch it off. Uh, Selling option. Now, how do we reduce the loss or reduce the risk? First is, as it was brought out, keep a stop loss. Or the other thing which has started is broker can close out positions if the required margin significantly exceeds the margin available. So, as what margin you have given to the broker, if the margin limit is crossed, so the broker can close your position and you will just lose your margin money only. So, what is this margin? Option sellers are required to deposit some money called margin with the broker in order to place and maintain sell orders. This is basically to reduce the counterparty risk for the broker. Now, lower the margin block, higher is the ROI. Please keep your audio switched off. So, margin depends on risk of trade and volatility. So, it is not that there is a standard margin for all trade. Investments which are held in spot market can also be placed as margin, and out of the money options have lesser risk of trade and hence lesser margins. But there's one more thing which we must understand, that all the in the money options, since they have higher risk, they have higher margin requirement also. So when the position is closed, the balance margin after deducting losses is returned to the seller. So if the position is closed in profit, the entire margin is returned to the seller, and if the position closes in loss, that loss is deducted from the margin. So basically, if you see, margin is an option seller's investment, and for a given profit, lower the margin is blocked, higher would be the return on investment. Simple, basic way to understand the position. Liquidity in derivatives is measured as open interest. So you have to also do option selling in contracts or in stocks where there is higher amount of liquidity. If the liquidity is less, you will still lose money. And what is open interest? It is the number of outstanding contracts or the number of contracts which have not been squared off. So that is open interest. Now you will see most of the open interest is always closer to the spot price. And just for information, spikes in open interest away from spot price also provides information on the key resistances and support levels. Now, what is the delta's influence on option strategies? Because there, as we have discussed earlier, there are large number of option Greeks. One of the option Greeks is delta. Now, I will take an example of the strategy which was given here in the group. That was to sell one lot of Infosys 1400C and also one lot of 1260 PE of Infosys. Now, the logic in my understanding of this strategy is like this. If I expect a large move in the underlying, but I am unsure of the direction, in such a scenario, I can amplify my return on investment by buying a pair of low cost. Like if you see, both of these are out of the money calls and put options. So I buy a pair of low cost out of the money call and put options. Now what happens here is my the premium is also less, but my margin requirement is also less. So what is the catch here? Now in case a large up move plays out, the out of the money put option, like say for example, if the price really goes up from the current market price, that is a spot price of Infosys, that is 1317 to say 1380, the out of the money put option, that is 1260 PE, would turn deeper into out of the money, but the loss would not be much, but and the loss would be less. But the out of the money call option would move subsequently into in the money territory and deliver spectacular returns. Based on this and vice versa, in case the price goes down, say if the price goes below 1260, then the put option will move in the money and the gains will be spectacular, but the losses would on the out of the money call option of 1400 C would be less. So as we see, I'll just revise the whole thing. Delta in this case is basically the change in option price per unit change in underlying price. So as the stock trades above the strike, the call option is in the money and option holder is in profit. So if you have a higher probability or higher conviction on underlying direction of a stock, you expect the magnitude of you expect the magnitude of the movement of stock price to be small. You should buy an in the money option. I'll repeat, if you have high conviction on underlying direction, like the one which I was showing yesterday on persistent, and you expect the magnitude of the movement to be small, that the stock will go up, but the price movement may not be that much. So you should buy an in the money option because you will gain more gains because of delta. So this is in nutshell is the delta. Delta is the measure of probability that the option would expire in the money. The value moves from 1 to -1. We will discuss it subsequently, this issue about delta. So I have finished. We can have a discussion on these issues. Thank you.